You might think $100,000 invested means financial freedom through dividends. After all, the math sounds simple enough, right? But here's the surprise. In a broad market fund, that six-figure investment typically pays only about $1,500 a year, or roughly $125 a month. In this video, I'll show you what $100,000 actually produces in three different scenarios: a broad index fund, a high-yield dividend stock, and a growth-focused company. More importantly, we'll break down the trade-offs each one focuses between income now and long-term growth. And if building wealth is your goal, consider subscribing for more straightforward financial breakdowns like this. Because the truth is, dividends alone aren't the engine of wealth growth. Capital appreciation is. But if that's the case, what does $100,000 in an index fund really give you in practice? A lot of people picture $100,000 as the kind of financial milestone that should finally start paying them back with steady cash flow. It feels like a number that ought to create tangible, reoccurring income, something close to financial independence. But when that money goes into a mainstream index fund that tracks the S&P 500, the stream of cash is far smaller than most people expect. With a yield of around 1.5%, $100,000 returns only about $1,500 per year. That's roughly $125 per month, or $375 each quarter. It's real money, but nowhere near the kind of lifestyle support many hope for when they first cross the six-figure threshold. The reason that number feels so underwhelming is because dividends make up only a small portion of what the S&P 500 historically delivers. The bigger story is the long-term total return, which has averaged about 10% annually over many decades. In that figure, the dividend yield is just a sliver. Most of the growth shows up in rising value of the shares themselves. Reinvesting those small dividends compounds the effect further, leading your holdings to multiply substantially over time, even if the cash payments land in your account look modest in the short run. The simplest way to visualize this difference is to think of dividends as loose change you find in your pocket. It's nice to have, but it's not where the real wealth comes from. The bulk of your earnings, the equivalent of your paycheck, comes in the form of capital appreciation. And while you don't see it as immediately as a cash deposit, it's quietly working in the background year after year. Here's why this gap matters for investors. When people first confront the reality of just $125 a month in dividend income, it often feels disappointing. Expectations run high because many assume a larger dollar amount invested naturally produces strong, reliable payouts. But wealth in an index fund doesn't materialize through high dividends. It comes through growth. Every time dividends are reinvested, it's like planting seeds that will grow larger over time, gradually producing more value than those first small checks could ever deliver on their own. This long compounding process can be easily overlooked, but it's the core driver behind index fund investing. That's where the tension lies. The S&P 500 is considered one of the safest and most effective vehicles for building wealth long-term. Yet, its immediate dividend income feels underwhelming. For younger investors, this trade-off usually works in their favor because growth has more time to compound. But for anyone fixated on current cash flow, the math can feel unsatisfying. The urge to seek out bigger, faster payouts is strong, which is why many investors start shifting their attention towards high-yield opportunities. And this is the key turning point. If an index fund only drops $125 a month into your account, where do people turn when they want bigger payouts? And what kinds of risks come with that search? What grabs many investors next is the lure of higher-yield dividend stocks. On paper, the idea looks powerful. Instead of collecting around $1,500 a year from an S&P 500 index fund, you could be receiving more than $7,000 annually without adding another dollar of your own. Companies like Iron Mountain, for example, offer yields of about 7%. That's more than 4 times what an index fund pays, and those checks show up on schedule. Suddenly, it feels like your portfolio is delivering a tangible paycheck instead of just numbers that rise and fall on a chart. That sense of immediacy is part of the attraction. Getting a few $100s wired into your account every quarter feels different from watching share prices crawl upwards in the background. For many people, it creates a sense of progress and security. Unlike capital appreciation, dividends don't force you to make a decision about selling shares. The cash arrives on its own, no questions asked. And psychologically, that feels like proof that your money is finally working hard for you. But here's where reality intrudes. High yields tend to come with trade-offs that aren't obvious at first. Most often, they reflect one or two situations. The first is a mature business that has already saturated its market and has a few opportunities left for expansion. Since management can't reinvest profits as effectively as before, A big portion of earnings is returned as dividends. The second situation is more worrisome. When a company's stock prices fall sharply, the yield, calculated as dividends relative to price, suddenly spikes higher. In that case, the yield isn't really an opportunity, it's a warning sign that the business may be under stress. In both scenarios, the outcome can lead to future dividend cuts and steep stock price declines. Think about the chain reaction that happens when a dividend is reduced. Income-focused investors often sell immediately, driving down the share price even further. At the same time, you're losing the very income stream that attracted you in the first place. So instead of the steady $7,000 you thought you'd secure, you could end up with less income and a smaller portfolio value at the same time. What once looked like a shortcut to passive income turns into a double hit. This explains why chasing high yields is riskier than it appears. A strong dividend can last for years, but it's only sustainable when it's supported by equally strong cash flow and balance sheet health. If those foundations weaken, the payouts that once looked generous can disappear just as quickly. So as an investor, here's the practical question. Would you take $7,000 today if it might mean less growth and possibly less stability down the road? Now, this doesn't mean high yield stocks are always a trap. In some cases, they can deliver steady, useful income, especially for retirees whose main priority is cash flow, rather than long-term appreciation. But for investors looking to grow wealth across decades, the limits are clear. When companies maximize dividends at the expense of reinvestment, they trade away much of their future growth potential. Over time, that gap compounds into a substantial difference in total returns compared to businesses that prioritize expansions first. That brings us to a different kind of strategy. Stocks that pay only modest dividends but focus heavily on reinvesting profits back into their operations. They don't deliver the excitement of a large quarterly check, but their ability to expand, innovate, and increase in value can create a very different outcome for long-term investors. What if small dividends today produce much more wealth later? That's the core idea behind low-yield growth stocks, the kind of companies that deliberately keep payouts small so they can reinvest profits back into the business. At first glance, the income feels almost irrelevant. A $100,000 investment in a company like Apple or Microsoft might return only $500 to $1,000 in dividends per year. Compared to the $7,000 from a high-yield stock, that sounds unimpressive. But the real value isn't in the size of the dividend, it's in what happens to the underlying investment over time. These businesses prioritize reinvestment. Instead of pushing earnings back into shareholders' pockets, they funnel billions into research, development, new product lines, market expansion, and acquisitions. That extra reinvestment helps grow their profits, and when profits grow, share prices tend to rise as well. In other words, the money you don't see in your account today is still working, just inside the company instead of outside. The effects can feel invisible at first, but with each year, the compounding impact builds. Apple and Microsoft are prime examples. For years, they paid very little in dividends, choosing instead to focus on innovation and expansion. Investors who focused only on cash flow may have dismissed them, but those who stayed invested saw share prices multiply, producing gains that dwarfed the missing dividend checks. What looked like a trade-off, accepting meager payouts, turned into exponential growth when measured by overall wealth. This is how retained earnings create future stock price appreciation. By redirecting dollars into opportunities that strengthen market position and create new revenue streams, growth companies increase their long-term earning power. That expanding capacity gets reflected in the stock price, and as investors, you benefit through a portfolio that tends to grow many times over. Think about it this way. A $500 dividend in your pocket each year may not change your lifestyle. It might cover a dinner or two, but it doesn't set you free. On the other hand, if that same investment grows over the years to be worth several multiples of its original value, the wealth you build far outweighs the income you gave up in the short run. The smaller cash flow today becomes the price of owning a much larger asset base tomorrow. The trade-off is especially powerful for younger investors with long time horizons. When you don't need immediate income to pay living expenses, compounding growth becomes your biggest ally. Every extra dollar the company puts towards future expansion acts as rocket fuel, accelerating your portfolio's expansion across decades. What feels like a meager yield in the present often results in far larger wealth accumulation by the time you actually need to tap your investments. One more point is crucial here. Growth stocks don't ignore dividends completely. Many actually do pay them, and often, they raise them slowly over time. That steady increase signals a healthy business that balances reinvestment with rewarding shareholders. Some of the biggest long-term performers fall into this category, combining annual dividend growth with rising share values to deliver strong total returns. The key takeaway is not the size of this year's payout, but how sustainable and scalable the company's growth strategy is over the long haul. This perspective challenges the idea that maximizing income today is always the smart path. In fact, what really matters is whether you're better served by steady cash payments now or by reinvested profits silently growing your account in the background. And that naturally raises a deeper question that every investor has to wrestle with. Is your priority immediate income or long-term wealth? Your time horizon and needs should decide whether you chase income or growth. That's the central point here. The dividend investing isn't about what looks best on paper. It's about what aligns with your life and priorities. A retiree who relies on portfolio cash flow will naturally approach things differently than someone in their 20s with decades of growth ahead. Your goals are the real answer. To see how much difference your choices make, consider a simple 20-year hypothetical. Imagine two investors, Sarah and Tom. Both start with $100,000 and invested in the same way. Sarah reinvests every dividend, buying new shares each quarter. Tom spends every dividend as soon as he gets it. In the early 20s, their portfolio looks nearly identical, and Tom even feels ahead because cash keeps landing in his account. But compounding silently builds in Sarah's favor. After 20 years, Sarah's portfolio grows to around $600,000, while Tom's sits closer to $400,000. Nothing separated them except reinvestment, and that single decision created a $200,000 difference in wealth. Taxes add another layer of reality. Unlike capital gains, which you can control by deciding when to sell, dividend income in a taxable account gets taxed every single year as it's paid out. In a 22% tax bracket, for example, a $2,000 annual dividend shrinks to just $1,560 because $440 goes straight to the IRS before you even touch it. That money never compounds. The same dividend inside a tax advantage like an IRA or a 401k can be fully reinvested without immediate taxes, which means far more potential growth across decades. Just the choice of account structure can make a massive difference in long-term outcomes. But the math isn't the only force at work. There's psychology. Every dividend feels like a paycheck, and your brain rewards you with a little shot of satisfaction every time a payment arrives. That dopamine hit can make you more emotionally attached to high-yield stocks simply because they pay you more often, even if they're not the smartest wealth-building choice. If you don't actually need the income right now, one of the best ways to counter that mental pull is to set dividends to reinvest automatically. That simple action keeps your portfolio compounding instead of letting short-term impulses steer your decisions. The orchard metaphor helps put this into perspective. You can plant small trees that start bearing fruit right away, or you can plant saplings that need years to mature. The small trees satisfy you now, apples in hand, income in pocket, but they'll never sustain you long-term. The saplings demand patience, but when they grow into large productive trees, they develop abundance for decades. Taking dividends early is like chopping down a sapling for firewood. You get warmth for the moment, but you lose the harvest that could have fed you and your family for years. This is why the best approach is never about yield alone. The smartest investors ask which role dividends should play in their own plan. If you're living off your investments today, income has value, and a higher yield may be justified. But if you're building wealth for a future you won't touch for decades, compounding through reinvestment usually beats the quick gratification of bigger checks. And I'd love to hear from you on this. Are you investing for income today, or are you focused on growth for the future? Drop your answer in the comments and share your reasons why. Seeing different perspectives helps everyone in the community think through their own strategies. Ultimately, dividend investing isn't about chasing the highest payout or following the latest trend. It's about building a strategy that matches your time horizon, your tax situation, and your core financial needs. When you know what role dividends play in your plan, every decision, from reinvestment to account type, becomes clearer. And that's the real turning point here. Once you align dividend investing with your personal goals, you'll see that the dividends themselves are only part of the picture. What really matters is how you use them. Dividends aren't the destination, they're just one tool. Your timeline and needs decide whether income today or long-term compounding should take center stage. And the way you handle reinvestment and account structure often makes the biggest difference in how much wealth you actually build. Keep it simple. Use dividends in a way that matches your goals, whether that's steady cash flow or maximizing future growth. If you found this breakdown useful, hit like and subscribe for more clear investing comparisons. And quick, are you team income now or team growth later? Leave one word in the comment.